Good morning. Today we're going to introduce the topic of risk. The nature of the client's business affects the risk to which the auditor is exposed. The higher the likelihood the client will go bankrupt or incur significant losses, the more risk to which the auditor is exposed. The more difficult it is to understand the transactions in which the client enters, the more risk to which the auditor is exposed. If we go back to the section on legal liability, both the primary beneficiary and foreseen parties involved the purpose for which the client was having their financial statements audited, the purpose for which the financial statements would be used, and the parties who were going to rely on those audited financial statements. Those were two important components: the purpose underlying the financial statements being audited, how were they going to be used, the nature of the transaction they would be used for, and the party who was going to rely on those financial statements to make their decision. Both those affect our risk, so we want to know why the client is having their financial statements audited and who is going to use them and rely on them to make a decision. Understanding the client's business. I've often said you can't audit what you don't understand. If we think of 2008, 9, 10, the financial collapse, mortgage-backed credit default swaps or credit default swaps involving mortgage-backed securities were an underlying part of the problem. In hindsight, it's obvious that many of the banks that entered into those transactions did not understand the nature of the transaction. AIG, the big insurance company, apparently did not understand the nature of the transactions which they were effectively insuring. And it appears that the auditors had trouble understanding the nature of those transactions. If we think about Z-Best in the video that I asked you to watch, it's obvious that the auditors didn't understand the nature of the business. They tended to audit the carpet cleaning business when all the profits were coming from the restoration business, and the restoration business was a fraud. If they would have understood Z-Best business, they would have spent more time auditing the restoration business and less time auditing the carpet cleaning business. 315. Understanding the entity, its environment, and its internal controls. That's a thou shalt. Thou shalt understand the entity and its environment. Think about environment today. The business environment today is entirely different than it was 3 months ago, 4 months ago. And you're going to have to make adjustments in the audit. So the risks involved in business have gone up tremendously in the last 4 months. The auditor has to take that into consideration when they're determining the risk to which they're exposed. Think about the auditor's responsibility section of the audit report. It describes the auditor's responsibility to detect material misstatement. Think about the overall audit objective, AU 200. Both say whether due to fraud or error. Reasonable assurance about whether the financial statements are free of material misstatement, whether due to fraud or error. 200. Obtain reasonable assurance about whether the financial statements as a whole are free of material misstatement, whether due to fraud or error. The reason I point this out is we're responsible to design audits that will detect material misstatements, whether due to fraud or error. Fraud is usually much more difficult to detect than errors. Oftentimes, the client will help us find error. Client often is just as interested in finding errors as we are. But fraud, the client is involved, or at least some parties within the client are involved in hiding or covering up the fraud to make it much more difficult to detect. But we're still responsible for detecting material misstatements. Related party transactions. Page 304 talks about Enron. No one could understand how Enron made money. Incredibly complex business structure. Apparently the complexity and uncertainty surrounding Enron's business fooled their auditors too. Always question complex business structures. What purpose do they serve? Does the complex business structure serve an actual economic business purpose? It may. It may be for taxes, maybe for international reasons, but the reality is sometimes we just see complexity and there's no reason why the business needs to be that complex. Complexity is an enemy of the auditors. It's harder to audit complex structures, complex transactions, than it is straightforward. So related parties and complexity. Now, the book talks about declines in economic conditions. Wow, you're living in it. So think about the impact that has. There are businesses who are going to violate the covenants of their loans. Are they going to have incentive to misrepresent their financial statements in order to get that loan renewed? So the risk just changed tremendously in the last 4 months. Information technology, it's a wonderful thing when done correctly. But remember that, you know, a computer can enter transactions thousands of times faster than you can, but it does the same thing over and over and over. And if it is programmed incorrectly, that means it can make mistakes thousands of times faster than you can. So, and information technology is good, but be careful when they first adopt it, when they make changes to information technology, because the errors can compound themselves very, very quickly. Expansion. We always think of expansion as a good thing. When Cynthia Cooper talked about WorldCom, she talked about the rapid expansion. And all of a sudden you had an internal audit department that was designed for a company with, let's say, $100 million a year in revenue, trying to perform internal audit for a company worth tens of billions of dollars in revenue. The same thing was true of their accounting system. When a company's growing and expanding, investing in their accounting system is the last thing in the world they're interested in. They're trying to increase capacity, they're increasing their sales force, they're increasing their manufacturing capacity. These are all critical things to their growth. And oftentimes, the increasing the capability of the accounting department and internal audit departments lags a great deal behind. So expansion is a good thing, but it's also got lots of risk. Complexity of judgment, complexity of estimates, complex financial instruments. Complexity is the enemy of the auditor. Complexity makes everything more difficult by definition. So page 238, there's a little spiel about related party transactions. I want you to read that and read that and read that. Jumping ahead to chapter 9 on page 277, there's a little section on non-routine transactions, on judgment, and on complex transactions. Read that section, read it, read it, read it. Okay, these are all areas that increase the risk that the auditor will reach the wrong conclusion. We'll talk about those more, but go ahead and read them now and start studying those. Those are very, very important. Related party, page 238. Affiliated company, principal owner of the client company, or any other party with which the client deals, where one of the parties can influence the management or operating policies of the other. So the underlying part, if I were to ask you describe a related party, describe or define, this is what I'd want. Any party with which the client deals where one of the parties can influence the management or operating policies of the other. Notice it goes both directions. It's possible the client can influence the management or operating policies of the related party, or it's possible the related party can influence the management or operating policies of the client. Either way, we're not worried or we're concerned about it either way. The reason we're concerned is because with related party transactions, we can structure the transaction to hide financial problems. So we can enter the related party, can agree to structure transactions that will help our client hide their financial problems from us. Investors are concerned that the terms of the transaction may not reflect arm's length bargaining. Arm's length bargaining is a good thing. Okay, we worry about when it's not arm's length. So arm's length is good. In all your intermediate classes up till now, we've said we're going to value transactions at the fair value of what we received or what we gave up. If we receive cash or something with a value similar to cash, we say that's easy to value. We'll value the transaction at the amount of cash we received. That always assumes arm's length bargaining. Many years ago, when Christy was in the Bay Area, she needed a safe car. Patty and I had a sweet little Mazda Millennia. We sold her the car for $4,000. We wanted to get her out of the old car she was driving. So we told her we'd sell her that car for $4,000. Now, would I have sold that car to you for $4,000? Probably not. Several years later, Christy was rear-ended, the car was totaled, and the insurance company gave her $10,000 for the car several years later. So when it's a related party transaction, we have to be careful. It's not arm's length, and the strike price of the transaction may not reflect the actual value of the underlying asset. So this is the same thing. Any party with which the client deals where one party controls or can significantly influence the management or operating policies of the other party. Related parties are frequently involved in fraudulent transactions. Related parties are not always bad, but they can be riskier. All businesses have numerous related party transactions. So they're not just in and of themselves bad, but because they can structure transactions to hide problems, they're riskier. So we must be very, very careful when we're auditing related party transactions. Andy Fastel was the CFO of Enron. Special purpose entities. Enron had over 3,000, if my memory serves me right, had over 3,000 special purpose entities. They weren't all the same. So many of these special purpose owners, Andy Fastel was the owner. Oh, Does that raise a red flag? He's the CFO of Enron, and he is the owner of the special purpose entity. That should be a red flag right there. Now notice this special purpose entity had very, very little equity, very little common stock. They were structured in a way to meet the minimum standards for the FASB so that they wouldn't have to be consolidated as part of Enron. So they didn't want to consolidate these, so they structured them as special purpose entities to the T. But first of all, you sit there and say, wait a minute, how did they get to borrow all this money? Well, the reason they did was because Enron agreed to guarantee the bank loan for this special purpose entity. So not only do we have a problem with Andy Fastow being CFO of Enron and the effective owner of the special purpose entity, but we also have Enron guaranteeing to the bank the note. Now think about this. So Enron guaranteed. So you'll notice $997. We'll use $997 worth of our Enron stock to guarantee the loan. At the time these transactions were entered into, Enron was red hot. I'm going to say like Apple. Not really like Apple, but the stock was going up, and nobody could imagine Enron stock not continuing to go up, or at least staying the same. Well, when Enron stock started decline, then they had to use more of the stock to guarantee this loan. So if the stock was selling for $100 a share, then originally 10 shares of the stock could guarantee the loan. If it dropped $1 a share, it took 1,000 shares of stock. They had 3,000 of these special purpose entities, many of them structured like that. So you can see what happened as the value of Enron stock started to decline. Then you had a downward death spiral because they had more and more stock to guarantee these various notes. Okay, so this was a classic related party transaction. There are accounting standards related to related party transactions. Okay, financial statements shall include disclosures of material related party transactions. What are they? A parent company and its subsidiaries, subsidiary companies with a common parent, enterprise and trust for the benefit of the employee's parent, employee, benefit of the parent company's employees, the principal owners, the management, and members of their immediate families. So these are always related party transactions. That's not all of them, but these are always related party. Auditing standards on related parties. We must identify related parties, transactions, and satisfy ourselves concerning the required financial statement disclosure. So the company is required to disclose. The company is responsible for the preparation and fair presentation of the financial statements, which includes their disclosure. They're responsible for preparing the appropriate disclosures. We have to audit those disclosures and make sure that they've got the disclosures for all related party transactions and that the disclosures are adequate and appropriate. The next lecture will talk about analytical procedures. Thank you.